Welcome to the Deep Dive, where we try and make the complex a little clearer. Today, we're tackling a really big one, a critical area for anyone involved in global business: export finance and risk management.
It really is the foundation of international trade, isn't it? But, it's packed with specific rules, very technical terms, and financial instruments where the stakes are, well, incredibly high.
Exactly. So, our mission today for this deep dive is pretty straightforward. We want to give you that expert shortcut.
We're aiming to cut through all the complexity and just highlight the absolute essentials, the definitions, the key facts about institutions, the numbers you really need to know, those one-mark moments that help you get a handle on this framework quickly.
Because actually selling your goods overseas, that's only half the job, maybe less.
Right. The second those goods cross a border, you're stepping into this whole web of financial risks, political risks. It gets complicated fast.
And our sources are crystal clear on this. For any exporting business survival, let alone growth, it absolutely hinges on getting adequate finance, getting it on time, and crucially, getting it at an economical cost.
Without that financial structure being solid, the whole operation just isn't sustainable. It falls apart.
Which is why you've stressed focusing on institutional finance.
Yes, it really is the right answer, as the source material puts it, because it provides the structure, the regulation, the safety net needed for these international transactions. Otherwise, it could just be chaos.
Okay, so to understand that structure, you first need to grasp this fundamental split in how financial help is given to exporters based on timing, right?
That's the key distinction. You've got two main stages. First, there's pre-shipment finance. Think of this as the money you need before the goods even think about leaving your premises.
So covering things like raw materials, manufacturing.
Exactly. Buying raw materials, processing components, the actual manufacturing, packing, putting it in boxes, maybe storing it in a warehouse for a bit before it ships, is basically working capital, but it's tied specifically to a confirmed export order.
Okay, that's pre-shipment. And then phase two kicks in once the goods are actually on their way.
That's when we talk about post-shipment finance. This is the financial support extended after the goods have been shipped out.
And why is that so vital?
Well, there's almost always a time lag, sometimes quite a long 1 weeks, even months, between when you ship the goods and when you actually see the payment from the overseas buyer. Post-shipment finance bridges that gap. It keeps your cash flow going while you wait for the money to arrive.
Got it. So pre versus post, that's the lens we need to use. Let's start unpacking the system then, right at the beginning. How do exporters actually get paid? What are the tools?
You can think of them as the different ways the money actually travels. The mechanics of moving funds internationally. There are four main ones.
Okay, let's take them one by one, starting with the fastest and probably the most familiar these days.
That would be the telegraphic transfer, or TT. Essentially, it's an international wire transfer, an electronic fund transfer, or EFT. Speed is its big advantage.
So key things to remember for someone learning this.
Okay, number one, it's the quicker method. The money moves fast. Number two, because it's quick and direct, there's basically no risk for the person receiving the money once it's been sent. And number three, this is important, the exchange rate. The TT usually gets you the best exchange rate available at that moment because the bank's dealing with immediate funds transfer.
Right, makes sense. Now, what about the slightly older method, mail transfer, MT?
Yeah, MT sounds a bit dated, maybe, but it's still a defined process. It traditionally relied on things like the Simple Mail Transfer Protocol, SMTP. But the key point today is the bank's commitment on timing. The issuing bank promises to issue the transfer and send it out on the same day it receives the payment in the local currency at its center. It's obviously slower than a TT, as it involves mail or maybe a digital equivalent, but that same day processing commitment is the defining feature.
Okay, then we move to paper-based instruments, bank drafts and checks. The crucial difference here is about the guarantee, isn't it?
Absolutely, critical difference. A bank draft carries a lot of weight because it's prepaid, and importantly, it's guaranteed by the bank itself.
So the money is definitely there.
Exactly. The bank issues it, often drawing on its own branch overseas or a partner bank. It's like a pay order from the bank. That guarantee is so strong, it's sometimes called a banker's check. And because of that security, our sources say it's still the most popular method of remittance for many types of transactions.
Yeah.
The funds are secured before the draft is even sent.
Which is totally different from just a regular check.
Completely different. A standard check is just an instruction from an individual or a company to their bank asking them to pay. The funds are not guaranteed. If the account doesn't have enough money, the check bounces. So for the person receiving it, the risk is much, much higher compared to that guaranteed bank draft.
Right. And the last instrument, the most formal one in trade finance.
That's the bill of exchange. This is a really formal written instruction. It's drawn up by one party, usually the exporter, telling another party, like the importer or their bank, to pay a specific amount of money to a third party, often the exporter themselves or their bank.
It sounds like a key document for controlling payment.
It is. It's central to financing collections. The exporter prepares it, sends it, often with all the shipping documents, to the importer's bank.
And we absolutely have to distinguish between the two main types of foreign bills because it changes the whole risk profile.
Yes, this is crucial. First, you have the ordinary or clean foreign bill. Now, this is only really used if the exporter has a lot of confidence, sufficient confidence, in the importer's ability and willingness to pay.
Why such high trust needed?
Because a clean bill travels without the documents that prove ownership of the goods, like the bill of lading. So the importer can essentially get their hands on the goods before they formally committed to paying through the banking channel linked to those documents.
Wow, that sounds incredibly risky for the exporter in international trade.
It is. It shifts almost all the risk onto the exporter. You typically only see it in, say, long-term relationships with a proven track record, or maybe between related companies, like a parent and subsidiary.
So the much more common and safer option is?
The documentary bill. This is the standard for secure trade. Here, all the necessary documents needed to claim ownership of the goods, the bill of lading, insurance certificate, commercial invoice, are sent together with the bill of exchange.
And that gives the banks control.
Precisely. The importer's bank holds on to those crucial documents. They won't release them to the importer, meaning the importer can't get the goods until the importer meets the conditions set out in the bill of exchange. That might mean paying immediately or formally accepting the bill, which is a promise to pay later. It secures the transaction through control of the documents.
Okay, so those are the ways money can move. Now let's connect that back to the pre-shipment and post-shipment phases and look at the actual financial support systems, the institutional finance schemes that help exporters manage their cash flow.
Right. This is where banks step in with specific products, often at favorable rates, to keep trade flowing. Let's start back with pre-shipment finance. The most common tool here is known as packing credit.
And the name tells you what it's for.
Pretty much. The definition is very precise. It's credit given by a bank specifically to help an exporter pack the goods for shipment. But really, it covers that whole pre-shipment phase we talked about, buying materials, manufacturing, processing, right up to the final packaging.
Now, banks aren't just giving this away, I assume. What are the requirements, the eligibility criteria?
No, they're quite strict, designed to make sure the money is genuinely used for exports. Packing credit is normally sanctioned only when the exporter can show a confirmed export order, or even better, an irrevocable letter of credit, LC. The bank needs proof that a sale is actually happening.
And who can actually get this finance? Just the main exporter?
It's actually broader than that, which is helpful for the supply chain. Of course, the direct exporter is eligible, but so are recognized export houses, trading houses, star trading houses, superstar trading houses. Even the supplier providing goods to one of these export houses can sometimes access packing credit. It helps finance the whole chain leading up to the export.
You mentioned earlier there are two forms this finance can take, fund-based and non-fund-based. What's the practical difference?
Good question. Fund-based is what most people think of as finance. It's an actual loan or cash advance. Direct money flowing to the exporter to cover their expenses,
Yeah.
buying materials, paying wages, running the factory.
Okay. And non-fund-based?
Non-fund-based doesn't involve an immediate cash payout from the bank. Instead, the bank provides support through instruments or guarantees. Things like opening a letter of credit on behalf of the exporter, if they're importing components, for example, or issuing performance guarantees or bid bonds needed for securing contracts. It facilitates the trade without direct cash outlay initially.
When the bank does provide fund-based credit, like packing credit, they need security. The terms used are pledged or hypothecated. Can you clarify the difference? It often causes confusion.
It really does. It's a classic distinction in banking security. When goods are pledged, the bank takes actual or constructive physical possession of the goods. They might be stored in a warehouse under the bank's lock and key, for instance. The bank physically controls them.
Okay, so they have the goods. What about hypothecated?
With hypothecation, the goods remain in the possession of the borrower, the exporter in this case. But the bank still has a legal charge or claim over those goods. If the exporter defaults, the bank has the legal right to seize and sell those goods, even though they weren't holding them physically. Packing credit is usually secured this way, tied to the goods being produced.
And how much credit do they typically get?
The amount sanctioned is generally linked to the value of the export order. It's often calculated based on the domestic cost of production or the FOB, free on board, value of the export shipment.
Let's talk about the loan terms, specifically the time period and the interest rate. These seem crucial for keeping exports competitive.
Absolutely vital. The maximum period for packing credit is generally 180 days. This is aligned with typical manufacturing and shipping cycles for many goods. And the interest rate is the key benefit. It's concessional.
Meaning lower than normal market rates.
Significantly lower. It's subsidized specifically to help exporters keep their costs down so they can price their products competitively in the global market.
But there's a detail within that 180 days, a tiered interest rate. Why is that?
Yes, this is a very clever bit of policy design, actually. The interest rate is cheaper for the first 90 days of the loan. Then, for the next 90 days, up to the 180-day limit, the rate is still concessional, but it's higher than the first 90-day rate.
So it gets more expensive the longer you take.
Exactly. It's a direct financial incentive pushing the exporter to complete production, pack the goods, and get them shipped as quickly as possible. The faster they turn the order around, the less interest they pay. It encourages efficiency and helps speed up the whole export cycle for the country.
A nudge towards speed. Okay, besides the standard packing credit, there are a couple of specialized facilities mentioned. First, the running account facility. What's that?
This is a facility the RBI, the Reserve Bank of India, permits for established exporters with a strong track record. It's a significant exception because the bank can grant this packing credit facility even if there isn't a specific firm export order or LC yet.
Really? How does that help?
It gives major exporters much more flexibility. They don't have to wait for the formal paperwork for each individual order before starting procurement or initial production, especially if they have regular, predictable business. It smooths out their working capital flow significantly.
Makes sense for high volume players. What about the Red Clause LC? Sounds intriguing.
It does. The name apparently comes from the old practice of highlighting this special clause in red ink on the letter of credit document. The key feature of a Red Clause LC is that it allows the exporter, the beneficiary, to get an advance payment from the advising or confirming bank before they've even shipped the goods.
In advance, who takes the risk on that?
This is the crucial point. The credit in advance is given at the risk and responsibility of the foreign bank that established the LC in the first place. It's essentially the buyer's bank authorizing a pre-shipment advance to help the seller get started, with the buyer's bank bearing the risk if the seller defaults before shipping.
Interesting. Okay, one more pre-shipment tool. The foreign currency option, PCFC.
Right. Pre-shipment credit in foreign currency, PCFC. This is a really important alternative to getting packing credit in local currency. Like Indian rupees, it's available in all major convertible foreign currencies.
And the main benefit is avoiding exchange rate risk.
That's the primary advantage. If an exporter needs to import raw materials or components using foreign currency, getting PCFC allows them to borrow directly in that currency. They avoid the risk of the exchange rate moving against them between borrowing rupees, converting them, paying the supplier, and eventually receiving payment for their export. It's a key risk management tool.
Okay, that covers the pre-shipment phase thoroughly. Now let's shift focus. The goods are on the ship, the invoice is out, we're into post-shipment finance. The regulatory environment gets even more complex here, doesn't it?
It does, because now you have more international rules kicking in alongside domestic ones. Post-shipment advances are guided by RBI directives, yes, but also by FDI rules, that's the Foreign Exchange Dealers Association of India, plus the government's trade and exchange control regulations, and very importantly, the international codes set by the International Chamber of Commerce, like the UCP rules we'll get to.
Let's focus first on the payment terms that define the risk after shipment. The big distinction is DA versus DP bills.
Yes, this is fundamental to understanding post-shipment risk. DEP stands for Documents Against Payment. It's straightforward. The importer gets the shipping documents, like the bill of lading needed to claim the goods, only when they make the payment immediately.
Seems safe for the exporter and their bank. What about DA?
DA stands for Documents Against Acceptance. And here, the risk profile changes dramatically, especially for the financing bank. Under DA terms, the importer gets hold of those crucial shipping documents merely by accepting the bill of exchange.
Accepting meaning.
Yeah.
Just promising to pay later.
Exactly. They accept the usance bill, which is a formal promise to pay the full amount at a future date, maybe 30, 60, 90 days later. But they get the documents, and therefore usually the goods, right away.
So the buyer has the goods before paying. What if they then default on that future payment date?
That's the huge risk with DA. If the importer defaults later, the bank that financed the exporter has no security left. The importer already has the documents, probably already has the goods, may have even sold them. The bank is left relying purely on the importer's creditworthiness and ability to pay later.
So banks would be very cautious about financing DA terms.
Extremely cautious. They typically only finance DA receivables for importers with impeccable credit, or if the export transaction is insured or guaranteed by an agency like the ECGC, which we'll discuss.
Okay, that distinction is clear. Now, there are some specific types of post-shipment advances for tricky situations. What about advance against undrawn balances?
This happens quite often in practice. Sometimes the exporter doesn't draw the bill for the full invoice value right away because there are minor issues still being sorted out. Maybe a final quality check pending, a slight disagreement over weight or quantity. The bank might provide an advance against that undrawn balance, expecting it will be resolved and paid soon.
And for big projects like exporting machinery or building a factory overseas, there's advance against retention money.
Yes, particularly common in capital goods exports or large turnkey projects. The buyer often holds back a percentage of the payment, the retention money, as a kind of performance guarantee until the project is fully completed and signed off.
Can exporters get finance against that withheld amount?
Banks can advance funds against this retention money, helping the exporter's cash flow. But there's a key condition, a number to remember. The bank will typically only advance against it if that retention money is scheduled to be paid within 1 year from the date the goods were shipped, or the main part of the service was completed. That 1-year limit is a specific regulatory guideline.
Good to know. And just like pre-shipment, there's a foreign currency option post-shipment too, PSCF.
Exactly, post-shipment credit in foreign currency. Similar to PCSC, the exporter has a choice. Take the post-shipment finance in Indian rupees or in a foreign currency. If they opt for foreign currency, the interest rate they pay for that credit period is usually linked to an international benchmark rate. The source material mentions LIBOR, the London Interbank Offered Rate.
Even though LIBOR itself is being phased out.
Right. LIBOR is technically being replaced by other rates like SOFR, but conceptually it represents that global benchmark cost of funds for foreign currency borrowing. So the principal holds the interest is based on international market rates for that currency.
Okay. Lastly, in this section, let's clarify two terms often heard in larger financing deals. Buyer's credit versus line of credit. They sound similar but aren't the same.
Definitely not the same. Buyer's credit is quite specific. It's credit extended directly to the overseas buyer, the importer, by a financial institution, often one in the seller's country. This allows the importer to pay the exporter up front, usually upon shipment, while the importer repays the loan to the financing institution over time.
So the exporter gets paid quickly.
Yes, that's the main benefit for the exporter. They are out of the credit risk loop. It's important to note, though, if this kind of credit is arranged for a buyer who is actually resident in the same country as the bank, which can happen in complex deals, it usually needs specific approval from the central bank, like the RBI approval mentioned in the source. It's typically a loan tied to a specific buyer for a specific transaction or set of transactions.
And how does a line of credit differ?
A line of credit is generally much broader, more strategic. It's usually an arrangement where a financial institution, say in India, extends a credit facility not to a single buyer, but to a financial institution in the buyer's country.
So it's bank to bank.
Often, yes. That overseas bank then uses the line of credit to finance imports from the first country, India in our example, for multiple different buyers in their country. It acts as an umbrella facility, pre-approving finance up to a certain limit for a specific period, making it easier for many exporters from one country to sell to many importers in the other, facilitated by the two banks.
Right, much wider scope. Okay, we've covered the how of finance moving. Now, let's pivot to the rules, the documentation, the framework that stops international trade dissolving into disputes. Section 4, UCP and Letter of Credit Compliance.
This is absolutely critical, and if there's one acronym you take away from this whole discussion on documentation, it probably has to be UCP.
Okay, what does UCP stand for and why is it so important?
UCP stands for Uniform Customs and Practice for Documentary Credits. It's a set of internationally agreed rules, published and updated by the International Chamber of Commerce, ICO, based in Paris. These rules govern how letters of credit, LCAs, are issued, advised, confirmed, negotiated, and paid all around the world.
And its role.
It's universally accepted. Our source material calls it the Bible to banks when dealing with LCs. Every bank involved in international trade finance adheres to the UCP rules. This creates standardization and predictability. So an LC issued in Brazil is understood and handled the same way by a bank in Germany or Japan.
And within these UCP rules, there are some core principles that really define how LCs work in practice. Let's start with the one that sounds quite intimidating, the doctrine of strict compliance.
It is strict, and for good reason. This doctrine basically says that banks have the right, in fact, often the obligation to reject the documents presented under an LC if any document fails to comply strictly with the terms and conditions stipulated in the letter of credit itself.
Any document, even a tiny error.
Even a tiny error. A typo, a missing signature, a date inconsistency, information contradicting another document if it's not exactly as the LC demands, the bank can declare a discrepancy and refuse to pay. There's virtually zero room for error.
That sounds incredibly difficult to achieve perfectly every time. What's the logic behind such strictness?
It forces discipline and protects the banks, which leads directly to the second core principle. Banks deal in documents, not in goods.
Meaning the LC is separate from the actual physical shipment.
Exactly. The bank's obligation under the LC is totally independent of the underlying sales contract between the buyer and seller. The bank doesn't inspect the goods. They don't care if the goods arrived damaged or if they were the wrong color or even if they never arrived at all. Their sole job is to examine the documents presented.
So if the documents match the LC requirements perfectly,
Then the bank must pay, regardless of any problems with the actual goods or disputes between buyer and seller. This principle protects the banks from being dragged into commercial arguments they can't possibly verify. Their liability is based purely on the paper trail conforming to the LC and UCP rules.
and when those documents don't conform strictly, we get discrepancies.
Yes. Discrepancies are any errors, omissions, or contradictions in the presented documents compared to the LC terms. And there's another key point here about documents. If the exporter includes extra documents, ones that were not asked for in the LC,
The bank won't look at them.
the UCP rules state the bank will refuse to examine any documents not stipulated in the LC. They stick rigidly to what was agreed. No extra information is considered, even if the exporter thinks it might be helpful.
Okay, this is all about precision. Now, there's a critical time limit involved here, isn't there? The 7-day rule. This sounds like a number we need to know.
Absolutely. This is a crucial piece of data under UCP rules. Once the beneficiary, usually the exporter or their bank, presents the documents to the issuing bank, the buyer's bank, that issuing bank has a maximum of 7 banking days following the day they receive the documents to do 3 things. 1, examine the documents thoroughly. 2, decide if they conform strictly to the LC terms. 3, communicate their decision either acceptance, meaning they'll pay, or rejection, listing the discrepancies found.
7 banking days. That's not very long considering the complexity. What happens if the bank fails to make and communicate its decision within that time frame?
The consequences are severe for the bank. It's known as preclusion. If the issuing bank doesn't communicate its rejection, detailing the discrepancies, within those 7 banking days.
They lose the right to reject.
Exactly. They are precluded from later claiming the documents were discrepant, and they become legally bound to make the payment even if there were genuine errors in the documents. This rule forces banks to act quickly and decisively, keeping the trade finance system moving. Time is absolutely critical.
Wow, okay, so perfect documents within 7 days. To finish this section, let's quickly touch on the different types of letters of credit mentioned.
Sure. We have the standby LC, which often acts more like a guarantee of performance rather than a direct payment method for goods. Then there's the revocable LC. These can be changed or canceled by the issuing bank without needing the exporter's agreement.
Which sounds pretty useless for the exporter.
It offers almost no security, so they are very rare in serious international trade. The standard is the irrevocable LC.
Meaning?
It cannot be canceled or amended without the agreement of all the main parties: the issuing bank, the confirming bank, if any, the buyer, and the seller, beneficiary. This provides the security exporters need.
Okay, and the others?
We also mentioned the revolving LC, useful for regular shipments between the same parties, as it can be automatically renewed or drawn against multiple times up to a certain limit. And we already discussed the red clause LC, the one that allows for pre-shipment advances.
Right. Okay, we've covered finance structures, payment tools, and the critical documentation rules under UCP. But even with perfect paperwork, international business has inherent dangers. That brings us to our final section, business risk coverage.
Yes. No matter how well you structure the deal, risks remain. Business risk, simply put, is the chance you'll make lower profits than expected or even fail to hit your financial targets altogether. And when you trade internationally, the types and magnitude of these risks just multiply.
Our source material helpfully breaks these international trade risks down into 6 main categories. Let's list them so we know what we're dealing with.
Okay, the 6 key types of risk are 1. Commercial risks. 2. Political risks. 3. Risks arising out of foreign laws, often called legal risks. 4. Cargo risks or transit risks. 5. Credit risks. 6. Foreign exchange fluctuation risks or exchange rate risk. It's a pretty comprehensive list of things that can go wrong.
Let's put some flesh on those bones. What falls under commercial risks? These seem related to market changes.
They often are. It includes things like the exporter just not knowing the foreign market well enough, or the product suddenly becoming unsuitable, or unexpected price changes. Or really big one we touched on earlier is changes in exchange rates. If the currency of the country you're selling to depreciates significantly after you've agreed the price but before you get paid.
Your earnings shrink when converted back home.
Exactly. It directly hits your profit margin and makes you less competitive for future deals. Also under commercial risk are changes in government policies like import duties or tariff barriers. Even though bodies like GATT, General Agreement on Tariffs and Trade, work to reduce these, sudden policy shifts can still happen and make your product too expensive overnight.
What else? Transport costs, market tastes.
Yes, significant changes in transport costs can erode margins, as freight is often a big component. And definitely changes in market characteristics. The example given is a sudden shift in fashion styles for ready-made garments. If your container full of last season's style arrives after the trend has changed, you face a major commercial loss, especially if you weren't protected by an LC payment.
Okay, those are market-driven. What about political risks? These sound more dramatic.
They usually are, and often completely outside the exporter's control. We're talking about instability in the buyer's country or region. Things like a sudden change in the ruling political party leading to contract cancellations, military coups, major civil unrest or civil wars, or even acts of war where cargo might be captured or destroyed by hostile forces. These are major, often uninsurable risks in the normal commercial market.
Then there are the risks to the goods themselves while traveling, cargo risks or transit hazards.
These are the physical dangers of moving goods long distances. Think storms at sea, ships colliding, theft or pilferage from containers, leakage, piracy or high-sea robbery, fire, explosions on board, or spoilage, especially for food or temperature-sensitive goods. Basic shipping perils.
And the biggest financial fear for any seller, credit risk.
This is arguably the most fundamental risk in trade finance. It's simply the risk that the buyer will not pay for the goods or services they've received. Since selling on credit terms is pretty much essential to compete globally these days, almost every exporter faces credit risk.
And certain factors make it worse.
Definitely. The risk is higher in markets with a high rate of company insolvency or bankruptcy. It's also magnified when countries face balance of payments difficulties, meaning they might simply lack the foreign currency reserves needed to allow importers to pay for goods, even if the importer is willing and able.
Given how severe credit risk and political risk are and how hard they are to manage individually, this is where government support often steps in, which brings us to that key organization, ECGC.
Yes. Knowing this acronym and what it stands for is vital. It's the Export Credit Guarantee Corporation of India Limited. And critically, you need to know it's a Government of India enterprise.
And where is it based? Who oversees it?
Its head office is in Mumbai, and administratively it falls under the Ministry of Commerce. Its whole purpose is to support Indian exporters by providing insurance cover against the risk of not getting paid due to certain defined commercial and political risks.
How does ECGC organize its insurance products? The sources mention 4 main groups of policies.
That's right. They categorize them based on the type of export and the risk duration. 1. Standard policies. These are the workhorse policies, covering payment risks on short-term credit sales, which accounts for most regular export transactions. 2. Specific policies. These are tailored for larger, more complex, or longer-term deals. Think exports sold on deferred payment terms, paid over several years, contracts for services performed abroad, or big turnkey projects like building infrastructure overseas.
So, covering different types of export deals, what are the other 2 groups?
The third group provides support to the banking sector, financial guarantees. ECGC issues these guarantees directly to the banks, covering the losses banks might face if an exporter defaults on the pre-shipment or post-shipment loans the bank provided for an export transaction. It encourages banks to lend more freely for exports.
So it protects the banks, which helps the exporters get finance.
Exactly. And the fourth category is special schemes. These cover various other specific or niche risks. Examples include schemes that cover the risk a bank takes when it confirms a foreign LC, or special insurance against exchange rate fluctuations on certain long-term contracts, supplementing the cover banks provide.
Now, this is just as important. What does ECGC not cover? Understanding the exclusions is critical for any exporter relying on this cover.
Absolutely vital. There's a clear list of risks ECGC will not pay claims for. First, commercial disputes between the buyer and seller, particularly disputes about the quality or specifications of the goods.
Why exclude quality disputes?
Because ECGC insures against payment default risk, not performance or quality risk. If they covered quality disputes, any buyer unhappy with a shipment could just refuse to pay and trigger a claim. It forces exporters to manage quality control and potentially use other insurance for product issues. ECGC stays focused on credit and political default.
Makes sense. What else is excluded?
They also exclude losses caused by something inherent in the nature of the goods, like natural spoilage of fresh fruit that wasn't due to transit delays, but just its normal shelf life. Also excluded is the buyer's failure to obtain the necessary import license or foreign exchange authorization from their own government. That's considered the buyer's responsibility. And finally, as we noted, ECGC generally does not cover losses arising purely from exchange rate fluctuations.
And there was one other crucial policy point about only covering commercial risks.
Yes, very important. ECGC does not issue policies that cover only commercial risks, like buyer insolvency, while excluding political risks. Their mandate typically involves covering a blend of political and credit risks together, reflecting their role as a national export promoter, addressing risks beyond normal commercial insurance capacity.
Okay, so let's try to pull all that risk coverage together. Who ultimately covers what type of risk when these third-party agencies are involved?
We can summarize the typical risk transfer like this. Credit risk, buyer default, and most political risks are transferred to ECGC, or a similar credit insurance agency. Cargo risk, physical loss or damage during transit, and product liability risk, like quality issues, are covered by general insurance companies. Exchange fluctuation risk is often borne by the commercial bank, especially if they have purchased or negotiated the export bill under an LC, as they have mechanisms to manage or price in that risk.
That's a helpful summary. We have certainly covered a huge amount of ground today. We started right back at the beginning, defining those two fundamental stages, pre-shipment and post-shipment finance.
We looked at the mechanics, telegraphic transfers, mail transfers, the crucial difference between a guaranteed bank draft and a risky check, and the formal bill of exchange.
We dove into the finance schemes themselves, packing credit, that 180-day window with its built-in incentive for speed, the one-year limit on financing retention money.
And then the rules of the game. UCP, the Bible to banks, that absolute doctrine of strict compliance, and the critical 7 banking day deadline for banks to act on documents.
And finally, mapping out the landscape of risk, commercial, political, cargo, credit, exchange rate, and the vital role of ECGC, that Government of India enterprise, headquartered in Mumbai, under the Ministry of Commerce, defining what it does cover and, just as importantly, what it doesn't.
I think the main takeaway really is that international trade, while complex, isn't just left to chance. It operates within this highly structured framework designed precisely to manage risk and provide stability. Understanding that system, the finance options, the documentation protocols like UCP, the risk mitigation tools like ECGC, that's where the real competitive edge lies for exporters.
Absolutely. It's about mastering the system, not just making the sale.
And when you think about it, that whole intricate system we described, especially the LC part governed by UCP, it's still fundamentally based on examining pieces of paper, isn't it?
That doctrine of strict compliance, the 7-day clock. It all comes down to shuffling documents and checking them meticulously.
Which leads to a fascinating question, maybe a final thought for our listeners to consider. We've just outlined this system built on physical documents needing careful human examination within a fairly generous time frame of 7 banking days.
But we now live in a world rapidly adopting technologies like artificial intelligence for verification, blockchain for immutable ledgers, smart contracts that can trigger payments automatically based on real-time data feeds.
Exactly. Technologies that promise instant, secure, data-driven transactions. So the provocative question is, how sustainable is the traditional paper-based, UCP-governed letter of credit system with its reliance on strict compliance of documents examined over days?
When the underlying data about the shipment, the insurance, the customs clearance could potentially be verified instantly and immutably on a shared ledger.
What might the next Bible for banks look like in international trade? Will it still be about documents, or will it shift entirely to verified, real-time data points triggering automated execution, moving from document-centric trust to data-centric execution?
That feels like a huge potential shift on the horizon, something definitely worth mulling over.
It certainly is. The foundations might be shifting.
Well, that's all we have time for on this deep dive. We hope this breakdown has given you the essential framework for understanding export finance and risk management. Thanks for joining us.